Stocks bounced today. Whether or not this bounce is the end of that near-term pullback, or whether or not we look more like the Russell 2000 and have more of a protracted decline, that remains to be seen. So I'm going to kind of show you on the charts kind of what I'm seeing and as well as some red flags that I'm seeing. I'm going to point out some red flags that might suggest that we get more of a pullback eventually. Obviously, we can still be bullish until we're not, right? We can stay overbought. So I'm definitely not going to like load up on bearish trades here. But there are some red flags that suggest that when whatever catalyst occurs to start the pullback to be more than just this little shallow exhale that we had this week, that we could get a little bit deeper than we might be comfortable with based on what we've seen in the past. So I'm going to show you what those are. I'm going to show you this week's trends and this kind of risk off pattern, how it finished, and what to expect from that. And then our trade idea today with a high probability technical setup with a high probability trade idea. So let's go ahead and get started. Today is Friday, November the 22nd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right. Well, let's start off taking a look at the S&P 500 with the market forecast indicator here. You'll see that we have strong bullish posture still in the near-term line, popped right back above 50. So it's been a whole whopping one day below 50, and then popping back up. Now here comes the question: will we bounce up to a new high, which is pretty likely, if not, up into this area. But if we pop up to a new high and the near-term line's unable to get above 80, or if it does get above 80 just barely and stays well below this high, then we have a bearish divergence. And I've talked about that before, but that's the scenario, especially when you get as shallow of a pullback as that was. Again, that wasn't even a 23% retracement. That would have been down to 30.71. That would have been about another 20 points lower that we just never got. So, again, you kind of think about hyperventilating, and if you don't take a good, healthy exhale, and you keep taking shallow inhales, which is what the next one will be, then it gets choppy, right? Things get choppy, and we kind of go up and down, and that's kind of what I'm actually expecting because of how long the near-term run was. I kind of expect some chop coming out of this. And potentially even that divergence, the target for that divergence would be this low point in between. But again, it would still, and it might even, depending upon how high we go up, right? Because if we move this up, then that would set if we got up to say 3150 on the next run, 3153, then that would set up a divergence, a low point to come down to 3090 again, which would be, the target, would be the low point of the between the two higher highs. So that's another 43 points higher. I'm not sure we can get that big of a move, and especially kind of with Thanksgiving. Thanksgiving's traditionally a pretty bullish period, so we'll see if the markets take off. And again, if they do, we hit up to that level, then watch for that kind of decline afterwards. Because again, shallow exhale, shallow inhale, especially if it's really quick, and it's unable to get the near-term line up there all the way up, then that's where we go. But I think more likely scenario is we end up kind of coming into this area and we chop, maybe a little bit lower, and then we just kind of move around in this spot while the 4-week low point, as you'll see in a minute, kind of moves up into this area, and then we break out, to the upside. So that's kind of the more likely scenario. The posture's still bullish. We're not worried about any kind of, and it's strongly bullish, and market sentiment's rising. It's way up here. So we're not looking at any kind of, intermediate decline at all, not for a while. But as I've shown you this chart here before, the longer we go up to higher number than this without a 1% pullback, then the more likely the pullback that we eventually get ends up being more than 1%. It ends up being a little bit more uncomfortable and lasts longer, and potentially brings that intermediate line down closer towards 50, if not below 50. So the ideal scenario is right now we come down to 30.75. it's not looking likely because we closed above yesterday's high point today. So it's looking like we might bounce up a little bit in the short term. So that's why I tell you the more likely scenario before, but the better scenario would be that we would drop down here, because then we get the 1% drop, then we can get a new rally out of that and feel good about that rally. But now that's, as of right now, it's not the case. Our biggest low point here is 0.38%, and that's just not enough. That's actually about 0.5% to yesterday's low. That's just not enough of a pullback, right? It's gotta, we gotta have at least a 1%. In fact, I tweeted out about that today when the report came out about Ray Dalio being bearish and making a bearish bet. It's like, well, yeah, of course the market's going to drop by next March. We'll have at least a 1% drop sometime, because you'll see that it's hard to go as long as we have without a 1% drop. In terms of like being more than an expiration cycle, more than 1.5 times an expiration cycle, and that was a long expiration cycle here. So it's hard. Actually, this is the longer one. So it's hard to maintain that kind of move. So of course we're going to get a pullback. I think the article implied there'd be a lot more of a decline, but the principle is it's not a bad thing to get a 1% pullback. It's not a bad thing to get a 4% pullback or 5% pullback. If you take a look, if I were to change the zigzag here to 5% instead of just 1, here we go, and then I go out, say, like 5 years, then you can see in 2019 we've had 2 5% pullbacks. And one of the most bullish years that we've had. It's not a bad thing to get a 5% pullback. In 2018, we got 2 bigger ones here, because that was a market sentiment decline. Then we got some bigger ones over here. Again, another market sentiment decline. 2017 was the rare anomaly where we just didn't get one, and I think that produced expectations where bullish markets don't ever get 5% pullbacks, and hopefully 2019 has squashed those and shown that it's very normal to get at least 2 typically every calendar year. So going back to the market forecast chart, you can see the weekly chart for this. You can kind of see the bearish candle that we got up here today, so slowing down for the first time. But you notice on the weekly basis, market sentiment's actually almost crossing above 80. The intermediate posture is at 98.5, about as high as it can get, and the near-term line strongly bullish. So again, you're not looking for any kind of significant decline from, we typically don't fall off a cliff from such high levels unless we're extreme. And here we had an overbought cluster on a weekly chart with market sentiment. That's about as extreme as you get in January. And we had a couple more weeks of bullishness before we finally played that out. And you can see we're not even getting a bullish cluster right now. Now, next one we get will most likely include all 4 lines again, unlike this one and unlike these two. But we are in the scenario where we had the strong intermediate line up above 80. That opens up any strong bullish week to the possibility of an overbought cluster, Now, if we take a look at the Russell 2000, you can see it's still pulling back more than the S&P. And if you look at its weekly chart, you'll notice that it's got the strong intermediate posture finally for the first time. The moving average on the weekly charts dropped down, so that's why it's yellow. But we do have the dark green shading, and we do have the intermediate confirmation opportunity where you have overbought intermediate line with oversold momentum line. So that opens up the possibility of a bullish week, and a bullish breakout above 1600 on the Russell will be very bullish in terms of risk appetite taking off finally. But not quite there yet. I still think that you're kind of stuck in this range, as the daily chart will suggest, with this bearish near-term high that we're getting. We're kind of stuck here waiting for the rest of the market to exhale too before everything can really get going again. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen at the red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us 2 things. Number 1, you liked our video. Number 2, you want us to do it again Monday. So if you like our videos, let us know. If you don't like our videos, then don't click anything down there. Also, comment. What did you get out of our videos today? Always interested to see what value you got out of it. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. That link will take you to our free subscription plan where you get access to our Market Outlook community on our website and our forums, as well as a market commentary portion of our blog and webinars that we do archived and in the future going forward. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we created for viewers of this video. Also, if you're watching this video on our site, I do want to show you a few things here on our site. First of all, you can always get to the current Market Outlook video by clicking on Market Outlook right here. But by just mousing over it, you can see the archives of all the old Market Outlooks on any day. You can go back in the past, as well as the link to our live Market Outlook that we do before the market closes at 3:30 Eastern on the days that I do these videos, as well as a link to the community. Right here's our Market Outlook forum in our community that you get access to when you do our free subscription on our pricing page. So when you click on Market Outlook, like we say, it takes you to the current Market Outlook video. There's another link to those Market Outlook live. I know I get asked by a lot of you, about to follow up on old trade ideas. Well, this is the video where I follow up on every trade idea we've done, all the way up to the time that we close out the trade. We do it every time I do this. And we also put on today's trade idea already before the market closes, which was a good thing for us with Las Vegas Sands, because it had yesterday's trade idea. It had a really good day today, so I didn't have to worry about it running away in the morning. Running away from me in the morning, which has happened in the past before we started that video. Also, engage with us on social media here. Like today's Market Outlook tweet by clicking the heart right there. It opens up this new window. Hit like. You can also like today's Market Outlook Facebook post by clicking on this little thumbs up that takes you to your Facebook page, and you can like it there. Again, the more you engage with us on those platforms, the more Twitter and Facebook will promote our content to the top of your timelines when you log in, to make sure that you see all of the content that we put out there. All right, back to the charts, and you can see here on the long-term chart on this week's Hakinyashi candle, we did not close above last week's high. So it's not a neutral, it's not a transition candle. We're not looking for reversal anytime soon. But it is a slow. After 3 consecutive weeks of closing above the prior week's high, this is the first one where we didn't. So good sign, it actually was needed to get some kind of slow reversal, as you saw here. There's that June period I mentioned to you before. And then the following week, you notice we did. We broke out and closed back up above. So we'll see. I doubt that we'll get that, because there we were, that was a breakout to new all-time highs. We were already breaking new all-time highs at pretty much every higher close. So we're not in the same category. We're more kind of in this kind of category here. But I do, again, the expectation is 4 to 13 weeks of these bullish candles before we reverse. Well, this is 6 weeks. So we're kind of chugging along at a typical rate on this current intermediate trend. At the 3 green arrow chart here, of course, you got the 1 red arrow on the MACD. When you look at the 2-line version of that chart, you'll see that there's your red arrow, where the red arrow, the histogram there, that's about what we get, and then we turn back up, generally speaking, continue the trend. Again, there's that June period again, same thing happening over there. In this case, though, unlike in June, where we did get a 1% pullback here, and we did break the 8-day and tested the 17 briefly before bouncing, here we haven't. So that's why we're trading still at the 8-day. I think we're highly susceptible to a bearish divergence if we were to break up above 312.69, even just a little bit would open this up to a divergence, which would mean a little bit more of a exhale that you might be uncomfortable with. Had we not instead just pulled down the 307, 308 in that case here in the last couple of days, and then bounced off the 17, that would have been the more ideal scenario. Been healthier, we would have had a good 3 or 4% jump higher and been fine. But we don't always get what's perfect. In fact, we rarely get what's perfect on charts. You get what you get, and you adjust your expectations according to what price does. Fortunately for us, our expectations have been bullish on an intermediate basis for so long, and we continue to expect it to be. It just on the short-term basis, we might get more of a near-term pullback than as we saw in the Russell, where we did get more of a near-term pullback a couple weeks ago than normal, and we did get a bearish high afterwards that we have since pulled back down from. So the Russell kind of gives us a kind of a glance at what could happen on the S&P, even though the intermediate posture for the Russell, despite that. Despite this kind of, protracted, more uncomfortable near-term pullback, despite all that, the intermediate posture is still strongly bullish, and we're still easily above a rising moving average. So that's why I say if we get something like this on the S&P, it could very well end up looking like this has been for the Russell 2000. All right, from an intraday standpoint, you can see the 4-week range has been we haven't had a new high on the 4-week high point in 3 consecutive trading sessions. So, that's not like super long, but, you can see we've kind of halted. And the low tag is as far over to the left as you could possibly get. That after today, that's going to jump up to over here. So on Monday, you'll see the low point over here. By the end of next week, all these periods, these 4 periods actually would be done because there's a holiday next week. So the 4-week low point the following Monday after Thanksgiving will be right here, and it'll only take 1 day before it jumps up to what is currently actually the midpoint. So within about 6-7 days trading sessions, a week and a half, that's where the low point is going to be. And if the high point ends up being, if we don't get a new high then, and this creeps over here and over here and over here because we're not getting a new high, then we could have both the high and the low tag. Obviously, this would be over here in this direction, but we'd have both the high and the low in this area. That would be it, and it would be a tight range. And that would set you up for a good bullish breakout at that point. It could be bearish too, but considering the trend, you would expect more of a bullish breakout to continue the intermediate run that we're currently on, to the tune of the closer potentially to the 13-week side of those expectations. Let's take a look at today's volume and trading range. And if you think it's light now, wait till next week with Thanksgiving. But if you look at the 3 green arrows here, the volume at under 45 million, the trading range today was under 1.5 points. That's just extremes. Those are the lows here when you look at this. 45 million's way below, is down here, and then the below 1.5 points is way below here. So the ATR is just being dragged significantly lower, down to really low levels on the ATR to price ratio. And to give you an idea of how low that is, when you get down to this level where you're at, let's see, where are we at now? We are at 0.670488. So this level right here, that line is where we're at right now. Over the last couple of years, that has been the lows, right? So you can see, it was this stretch right here when we were bullish. It was this stretch right here when we were bullish. And then over here, it stayed down here for quite a while during this bullish run, before we got the intermediate pullbacks on all of these, when this one turned into a market sentiment pullback. Before 2017, which was such an anomaly year, and we spent practically the whole year below this level, it was that way here before the November 16 elections as well, and you can see some other instances of it. So this is about as low as the ATR gets relative to the price, which just suggests just how complacent we are. You look at the volatility index, and we drop close to extreme lows by the end of the day. So 12.5. Again, you look at that on a weekly basis, and we're flirting right there. And pretty much landed right on the 80% mark. You look at how many weeks in a row now. 1, 2, 3, 4, 5 weeks in a row, and that we have finished. The VIX has finished the week at 80% of VXV, which is the 3-month VIX. VIX is 30 days. So that's a long period of really low volatility. And I did want to show you this chart too, which is our 6F chart on our charting package that we have for Market Scholars. Whoops, not 6F. it would be daily price move 6D. For those of you who are premium subscribers, get access to our charting package here. But look how low historical volatility is relative to implied volatility. And if you can again compare this to some past precedent here, so let's go back 5 years, and then I'm going to set a horizontal line right at 0.0541. So I'm going to set a horizontal line here. Let's just do it this way, it's easier. Horizontal line, and we'll set it over here at 0.0541, I believe it was. Okay, so there's where we're currently at. You can see again back here we were similar levels, and the VIX was kind of at the same level as it is now. Look at 2017, we were spent pretty much the whole year here with the VIX as low as it was in 2016, again right before that election. So you can see we kind of get bullish on an intermediate basis when we get to these lows. So a little bit of a red flag that we want to keep an eye on, because that could turn any expected near-term pullback into more of an intermediate pullback. The last intermediate low point is right there. So we'd have, this has been the 1 near-term run. So we had some room to go down and still be bullish, right? We can get down to 30.24, probably dip the intermediate line at least close to 50, if not a little bit below it, and produce a new higher intermediate low point and rally up, right? That would be perfectly normal. You can see on this chart that we haven't got a 1% move up or down since all the way over here. Well, that was just barely, it was actually over here. So that 1% move up with the gap on October the 11th, it's been well over a month since we've had a single 1% move up or down, and the closest we got was this 0.996% move to the upside, and that 0.99% move just a couple of days. So and look, no 1% drops since the October 8th low that we bounced off of, since that near-term run started. That's a long period. I mean, you go and you look at this chart, and you can see there's a lot of 1% moves on here. And to go that long of a period, it's very similar to this period where we didn't get a 1% move up or down here either. And then that culminated in that drop. So looking very similar to some of these other really quiet periods in the market. All right, so to summarize, that was a pretty extended look at the technicals here in the markets. But to summarize that look, the trend is strongly bullish. We're pretty extreme overbought in the near term. We haven't had a good normal exhale yet that we could expect another few percentage points move higher, bounce off of. And we're seeing signs of of pretty strong complacency in the markets. Whether that leads to an intermediate pullback or not remains to be seen. And if it does, there's plenty of room for an intermediate pullback to occur and still produce a good bullish low that we can bounce off of and continue to trend higher in the long term, which is, would definitely be the case considering that this long-term run on risk appetite is just barely getting started. We just barely are rolling out of a really strong safety trade position. We're just barely getting out of that and still got a lot of room for us to close out of that before we get towards the end of a mature long-term run on risk appetite. So with that said, what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Hit that link. It opens up a poll. Hit either agree or disagree. If you click disagree, share with our community down below in the comments section what you're seeing that's different than what we just talked about there, and why you might have a different posture and what's driving that. Obviously, everybody's got their opinions, but what drives your opinion? Obviously, the other thing too is a lot of times our opinions are based on what we want the market to do, which is based on how we've positioned our portfolios. And the reality is that the market never does what we want it to do. The market does what it does, and then we react to it and position accordingly and change as our expectations change. But if you have different expectations of what we just came up with here, let us know what's driving that. What charts are you seeing? What indicators are you using? What macro indicators are you seeing that would suggest something different? Now let's transition into what's driving the price action. And here's the pretty much how this whole week has gone, the last 5 days. You can see crude oil started the week really weak, down 4.5%. before rallying and finishing the week flat, USO at least. TLT finished the week relatively strong, and the dollar ended up being relatively strong too. Real estate started the week strong. The same thing with crude oil and kind of with gold as well. This kind of risk appetite trade was off at the beginning of the week, and then risk appetite came in different forms, right? You see real estate sold off, gold sold off with the strength in the dollar, crude oil rallied, but stocks didn't, right? Stocks stayed down a little. International stocks really dropped down a little. So you can see it was, kind of it was safety trade, risk off at the beginning of the week, and kind of risk off by the end of the week. Not really risk on either by the end of the week. So we're really still struggling in small caps. You can see way down here, underperforming large caps by the end of the week, and both of them little negative numbers by the end. You can see what outperformed today: high yield growth, the Dow Jones Industrial Average, dividend stocks, value stocks. So even in the equity standpoint, those are still, they're still bullish trades, but they're kind of on the safety side of the bullish trades. You also see investment grade corporate bonds as well, mid cap stocks, and then finally you have growth and long-term bonds way down here, and small cap stocks lagging behind the Dow but outpacing the S&P. And then at the very bottom you have commodities. And remember, commodities have not really joined this run since this thing started on 10/8. Since that low point on 10/8, we've had this good run, and you can see USO has had a pretty decent run too, up 9.69%. But when you look at it on a weekly chart here, USO over this past 6 weeks that the S&P has been bullish, right? We've had a good bullish run in the past 6 weeks. Here are those same 6 weeks in crude oil. We've really been and unable here. Let's take a look at the actual futures contract. You can see here, let's do this too. Let's do a log scale and fit the studies. There we go. So you can see it a little bit better. If I zoom in, here's the 1, 2, 3, 4, 5, 6. There's the 6 weeks. They've been great. They've been bullish. We've been kind of gradually moving higher. We're not breaking old highs at all. We're not even getting above the 200-day moving average, and we're still in kind of death cross mode. So we're not really getting that big move higher in risk appetite. Here is the 10-year note, and you can see it's transitioned again to a bearish candle, the 10-year yield. So it's been unable to fill this entire gap so far. I actually wouldn't be surprised if this was temporary, but I also wouldn't be surprised if we didn't roll back down a little bit here, which would not be good for risk appetite. It would coincide with a bump in volatility. If you take a look at gold prices, not surprising it's pulled back, but you notice it's pulled back towards its own support level. So you can kind of see we've had a great, pullback in the safety trade. It appears that it's pulled towards support, and it appears to be slowing. So, it's been a big, in fact, if you take a look at the 3-month, well, really, let's go back to the 10, well, when was it? Really, it started pulling back here on 9.2. Here, let's go to the 1-year chart. Yeah, it kind of peaked here on 9.4, and let's see where long-term bonds peaked. It also peaked up here right about that same 9.4 level. So let's go back to the comparison chart here, and here we are, asset class comparison, and then let's change this time frame to 9.4, and up until today, and we'll do a daily chart. There's our safety trade pulling back, and you can see, that's a pretty 5-6% decline. You can see these equities doing really well, and crude oil doing really well. So that's a good little reversal. But keep in mind that from year to date, so if I go all the way back to, or even that December 24th time frame, up until the 9.4, and actually it was more like May. What was it, May? That we really pulled back. Let's go back to just the 1-year chart, and it really took off here when we peaked right about here on May the 3rd. That's when the S&P 500 peaked, and you can see gold started to take off from there, and bonds started to take off from there. That May 2nd, May 3rd time frame. So if I were to come here and say, okay, well, from May the 2nd all the way up to, what was that, the September the 24th, if I remember correctly, then you can see, or September the 4th, sorry, we were up 20%. In that short amount of time, those safety trades and real estate up there as well, up almost 10%. They were up a lot, so they have a lot to pull back from. And we're down 6-7%. That's great, but there's a lot for the safety trade to unwind, and we're still in the beginning stages. We're taking a breather from the unwind, but I expect more unwinding to occur before this intermediate rally that we're on. This, especially if it develops into multiple intermediate rallies, before this kind of longer term move is over with. If you take a look at the different foreign markets, you can see the pullback on some of these as well. A little bit more than others. You see some light pink shading in emerging markets, Russia, India, Korea, darker pink shading in Brazil and China. So all your emerging markets are weaker than your developed markets, and they're all pulling back in different stages too. But even the emerging markets are all still on strong bullish trends. Light pink shading with yellow lines, even dark pink shading with yellow lines, a little bit of a red there on China. But these are kind of similar to our Las Vegas Sands trade. Those are bullish patterns that we either bounce off of or we don't. But we expect in good bullish trends that we'll bounce off of it, similar to what it did over here when it briefly got that yellow line on that pullback. We bounced off to new highs. We would expect a similar thing to occur here. Really quickly, next week, you can see we don't have a whole lot until Wednesday. Wednesday, the day before Thanksgiving, we have GDP, a revision coming out, durable goods orders. On Friday, the half-day trading, the Chicago PMI comes out. Early in the week, you have the Dallas Fed, Chicago Fed, national activity. It's a combination of all of these. You also have house price, new home sales, Case-Shiller, a lot of housing with consumer confidence as well on Tuesday. So we got a pretty decent basket of indicators. We also have a pretty busy week of earnings announcements. You can see Agilent, Palo Alto, Hewlett-Packard, BHP all expected here on Monday. On Tuesday, here we go. On Tuesday, we have a few stocks that you'll recognize here. There's HP, Autodesk, Dollar Tree. Best Buy is down here. We made a trade on that in our technical analysis class today. Then you take a look at Wednesday, John Deere, Tiffany, which is being bought outright. John Deere and Tiffany do out quite a number on Wednesday, and then Thursday, of course, is Thanksgiving, and then on Friday you have one. So there's some pretty big names that are due out with some earnings in essentially 3 days next week before the week wraps up. So typically the volumes and volatility will slow down. They'll really slow down Wednesday afternoon into Friday as well to finish off the week. But Monday and Tuesday are looking like they're going to be pretty decently busy weeks in terms of what's out there, what some earnings, and early Wednesday morning too with the basket of data. So we could get a good 2.5 days of volatility potentially before things really slowing down midday Wednesday. So kind of keep your eyes on those first few days and see whether or not we might get the bump up to that divergent high point. We might have enough juice, enough fuel with these different indicators and earnings to fuel a move to the upside, even without the trade announcement, to get that divergent high formed. All right, let's take a look at the sector moves and how they've performed. Now you can see, the healthcare sector, financials had a really good week. Interesting to see utilities and financials kind of both up here at the same time. But all these other cyclical areas, including materials, Consumer discretionary, industrials, technology, all really lagging. The big drop in energy by the end of the week here, even though crude oil was finished the week strong, but energy are well off their lows. So energy had a good run here for a while. Also interesting to see real estate down here and not up with utilities and staples. And you see communication services up there, which remember has a utility kind of an interest rate sensitive component to it as well. So it can behave like the safety sectors, but it can also behave depending upon how Facebook and Google do and Netflix. It can also behave like these cyclical areas down here at the bottom, and you can kind of see which side it's taking right now. So again, kind of a risk off pattern, which really was risk off early here. Then real estate took a tumble, and the others kind of held up, off their highs but held up. So it started off as a really risk off and ended up still being kind of risk off by the end of the week. And so again, are we going to continue that that risk off move in the next week, or is that the transition now into more risk on? And again, considering Thanksgiving weeks can be bullish, wouldn't be surprised if we moved up on really low volumes too to a divergent high point next week surrounding that holiday. All right, when you look at just today, you can see consumer discretionary had a really good day today, and I wanted to take advantage of that with our trade idea of the day. Let's take a look here at Royal Caribbean. It had been bearish, but it's breaking out. You can see a strong bullish pattern here on the market forecast with a new near-term bump starting. You take a look at its 3 green arrow chart for Royal Caribbean here. You can see you got 3 green arrows. We've had the surge. Here's the initial momentum surge that starts the intermediate run, and now we're just kind of grinding our way higher, but a good bullish pattern on the 3 green arrow charts. When you look at this chart here, you can see we're still riding the 8-day moving average up. The percent D here on the the MACD's moving average is just getting to strong levels. The stochastics percent D is well in the upper reversal zone, so buyers are well in control of the stock right now. If you take a look at its Bollinger Bands, here's RCL. You can see we just barely broke above the point of control, pulled back and tested it, this little near-term pullback, and now are bouncing up off of it and clearing some significant volume resistance as we do so. So you don't know how much upside you have without considering we've been bullish this whole time, but you also know that you've got some pretty strong support below there at 115. So we can sell a strike price at that 115, buy the 113 for support, depending upon where you get filled in at. We ended up getting filled in here in our trade on the Market Outlook Live. Where did we get filled in at 7 contracts at 343. Looks like about 49 cents is where we got filled in there on that trade. And again, full position size because there's no earnings between now and December expiration. And of course, if it breaks that support, breaks 115, then we'll get out of it, right? And we'll get out of it with hopefully at most a $343 loss. I don't want to take the full $1,000 loss. Much easier to come out back from a $343 loss than it is $1,000, especially with these types of trades. So that's how we're set up. High probability setup on the chart, considering the trend and the strong support. High probability trade. Not a lot of profit potential, but profitability and probability have an inverse relationship. So the higher the probability of success, the lower the profit potential will be when you look at a reward to a risk standpoint. Here, we're risking $3 to make 1. When we do lower probability trades, we typically do the inverse, where we risk $1 to try to make 3. Those are more directional trades when we have, like Las Vegas Sands was yesterday. This is less of a directional trade because we've already had the directional move. And now we're just hoping that it will continue to stay bullish and stay above support, and that will get us to our maximum gain on the trade. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forum. I also showed you how to get there on our site earlier in the video. But open up any new threads and let's get some conversations going about what we discussed in the video tonight. Or for that matter, anything related that we didn't discuss in the video, and be sure to reply to other people's threads as well. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Also follow me on Twitter for more content in between the videos, and then join our community at marketscholars.com, as well as the community we created on Facebook with our Market Outlook group. Again, have a great rest of your weekend, everybody, and we'll see you all on Monday.